Okay, so today we're going to be looking at IFRS 13 on fair value measurement. So again, this standard fair value measurement, it's also a joint effort between the Financial Accounting Standard Board, which is the board that develops standard in the US, and also the IASB, which is the body that develops IFRS. So jointly, they came up with this standard. And remember, the same thing was that of impairment of financial assets too. It was also a joint effort between them. So you see, these guys are gradually moving towards synchronization and harmonization. They want their standard to be similar. Okay, now IFRS 13, what it came to do is that it actually came up with a single framework for determination of fair value. So when we are talking about fair value measurement in any of the standards, like when I was teaching you financial instruments, we mentioned a lot of fair values. But today, we're going to learn how to determine that fair value. Because how to determine that fair value is in line with IFRS 13. When I was teaching you IFRS 2 on share-based payments, you will hear that also mentioning fair value, especially fair value of the share option at the grant dates, and the fair value of options at the reporting date, fair value of shares and all of that. Now, the determination of those fair value is also determined in IFRS 13. So what IFRS 13 comes to do is that it's saying that the determination of fair value, anywhere you mention or you hear fair value in any standard, how you determine them is guided by which standard? IFRS 13. But it is worthy to mention, there are two standards that I think you should be familiar with by now that are not covered under IFRS 13. Okay, in terms of how you measure those fair value. Number one, I mentioned IFRS 2. You see, the fair value determination in IFRS 2 is not covered in what we're going to teach you today. Fair value determination in IFRS 2 is how it is prescribed in IFRS 2. Because if you look at IFRS 2, especially equity settled share-based payments, the way we determine fair value there is using the fair value of the share option at the grant date, at the historical date. That is not in line with IFRS 13. So determination of fair value in IFRS 2 is outside of that of what? IFRS 13. Another one is determination of net realizable value in IAS 2. In determining net realizable value in IAS 2, that is in line with that of IAS 2 on inventory, not in line with IFRS 13. It's scoped out. So they have left IAS 2 on inventory to determine its own what? Net realizable value. Because when you look at net realizable value, we are looking at fair value or selling price minus cost to sell. IFRS 13 does not consider transaction costs when you are determining realizable value. So there are different bases of measuring what? Fair value. So I think you should note those two. That IFRS 2 and IAS 2, their determination of fair value is outside the scope of what? IFRS 13. Now the second thing is, what is then fair value? We need to understand how IFRS 13 defines fair value. Let's look at it. So, definition. Definition of fair value. Fair value is the price that is received to sell an asset or paid to transfer a liability in an orderly transaction between market participants. At the measurement date. Fair value is the price that is received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement dates. You need to know this definition by heart as a corporate reporting student. Now, from this definition, there are 4 key elements here that we need to break down, and it explains how we determine fair value entirely. So I'll bring out those 4 key elements, and I will use those 4 key elements to explain this definition. So you can note this down. Element of fair value measurement. Number one is exit price. Exit price. Number 2 is orderly transaction. Number 2 is orderly transaction. Number 3 is market participants. Number 3 is market participants. Number 4 is measurement date. Number 4 is measurement date. Okay. Now, the opposite of exit price will be entry price, right? Looking at this definition, he said fair value is the price that is received to sell an asset or paid to transfer a liability. That sentence, because it's a complete sentence, that sentence is demonstrating an exit price. Exit price for both an asset and the liability. For the asset, you are saying is the price that is received to sell, not the price that is paid to acquire the asset. We are talking about the price that is what? That means that the holder of that asset is intending to exit that asset. And it is from that perspective, from that position of exiting, that we determine fair value. That position of exiting, not entering. We are not looking at it from the person that wants to buy, but we are looking at it from the angle of the person that wants to what? That wants to sell. So it is the price that is received to sell an asset, or paid to transfer a liability. So when you have a liability, we are not looking at how much you originated the liability. If you had borrowed 100 million or you are owing 100 million, that is not the fair value. That might be the carrying amount. The fair value is how much you would pay to transfer the liability. It's just like you have a loan. You owe somebody 100 million. And for one reason or the other, another party is ready to take over that loan from you for 95 million. That 95 million is the exit price. That 95 million is the fair value because it's the amount that you pay to transfer the liability. Exit price. So if you have shares in, let's say, GT Bank, you have 1,000 shares and you bought those shares, let's say, at 300 naira each. At 300 naira each. But at the reporting date, the shares is now 400 naira. At the reporting date, when I say reporting date, you know I mean year end. At the reporting date, let's say December 31st, the shares is 400 naira. Let's say you bought those shares 5 years ago for, let's say, 300 naira. But this year, at the reporting date, the shares is now 400 naira. And they predicted that next year, February, the shares will be 350. In this case, you want to get the fair value, how much you can sell those your shares, so that you can determine the fair value. Out of these three figures, what will be the fair value? Is this. Because at the reporting date, is 400 naira is the price you will receive to what? To sell the asset. Or probably you have an investment property in Ikoyi, and you bought that investment property 5 billion naira 2 years ago. And at the reporting date, when you want to get how much you should value that investment property, because you need to, the way you can know how much the value is now, is for you to look for information on how much they just sold a similar asset in the same location. So they said in the same location today, they sold a similar asset for 7 billion naira. How much will your fair value be? 7 billion naira. That is what I mean by the price that is received to what? To sell an asset. Or the price that is paid to transfer a liability. Exit prices. Exit price. Just to be sure that you understand what I'm saying. So, let's say you have a startup. The one that is popular now. Let's say you have a fintech startup. And that startup, they have invested like 700 million naira to date. So somebody wants to invest in that business. And the person is ready to bring in some billions. So how are you going to get the fair value for that? You have a fintech startup. A fintech. A company. And it's a private company. It's not like it's not like the one that you can easily get the share price on the market. So you have spent 700 million to date. 700 million naira to date. Somebody wants to invest in that startup. They need to know the fair value. Based on this definition, how can we determine the fair value of that? What would be the exit price? What would be the exit price in that scenario? Million to date. Okay, let me give you an additional clue. So let's assume they have estimated that for the next 5 years, you are going to be making around 100 million per annum. Let's say they have estimated you are going to be making 100 million per annum. So how can we determine the exit price?
Based on what you had defined, right, I would look for a similar fintech company that's probably made a sale, right? Whatever amount they sold, then I'll use it, maybe the X of that amount to value my own business.
Okay, let's assume this they sold oh, they have sold that their own business. Oh, okay. So she said
At that
that
date,
at that date. Okay. I mean, good initiative. So she said she will look for a similar company, okay, that was just acquired. Then we look at how much that business was acquired for. Then on that basis, we use that to determine how much her valuation will be. Okay, good. So for a company like that, that is likely possible. That is likely possible, but there will be a lot of adjustment that will have to be made. There would be a lot of estimation that will have to be made. So the way fair value is determined in those scenarios, I told you that this company makes 100 million per annum for the next 5 years. All you just need to do is just to estimate those future cash flows, discount them to present value. That present value gives you your fair value. That's the exit price. So they said they make 100 million per annum, okay, for the next 5 years. So you just need to use discounted cash flow. Yes, 500 million. No, the 700 million is nothing. That 700 million is entry price. That's not exit price. So in that respect, you are going to use a discounted cash flow approach to determine the fair value in those scenarios. That is the only practical way. So looking for comparative business, how much they acquire it, there are a lot of variables involved that will make that not suitable. That can only be suitable for investment properties because most of those ones they have similar characteristics in terms of they will be in the same location. It might be maybe 5 bedroom. It might be, I mean, the square meters and all of that. But a whole business is difficult to get market data for that. So the way to do that is for you to use what? Discounted cash flow. Well, it depends. I mean, it really varies. It really varies. So the last time we did practically, when one company wanted to acquire another, we used minimum and maximum. So we used 7 as minimum and 10 as maximum. So we had two fair values. Then we did average of the two to get the position. That's practically. Okay? Theoretically in the exam, they would give you the number of years. Okay? So that is also within exit price. That is also within exit price. Another one, when it comes to fair value again, let's say you acquire government bonds. You acquire some government bonds and you spend 50 million naira on that government bonds, right? And as of today, that 50 million naira, if you don't have market information as at what the value is today. So for those kind of assets, you can easily get a similar government bond that is in issue. Okay, how much are they willing to sell it for that? For those ones today, then you can easily use that to value your own what? Your own bond. Okay, so we can go on and on with a lot of examples, but fair value is the price that is received to what? To sell an asset or paid to transfer a liability. Now, that's the first part of it. The second part of it is orderly transaction. And from this definition, we're told that it must be in an orderly transaction. So when we say orderly transaction, there are 3 or 4 things that it can mean when we say orderly transaction. A transaction that is orderly. Number one, we assume that the transaction will take place under normal market condition. Under normal market what? Market conditions. What I mean is that the transaction is not going to be a forced sale. It's not a distressed sale. It's not like you need money desperately and you have to exit. That is not a normal transaction. So it has to be in a normal market what? Market condition. Another one, when we say orderly transaction, it means that the participants, both the buyer and the seller, they are knowledgeable about the asset in questions. The buyers and seller are what? They are knowledgeable. Not only that, they are even independent. In an orderly transaction. So, independence is that they are not related party. If they are related party, then that is not an orderly transaction. Number three, when we say orderly transaction, it means that the asset must be marketed for a reasonable period. The asset must be marketed for a reasonable period. So we expect that for a normal orderly transaction, you should not be in a hurry to sell. You should market it for months, if possible. It must be marketed for a reasonable period. That is an orderly transaction. And also, the price must reflect conditions in the principal market. The price must reflect conditions in the where? In the principal markets. So an orderly transaction is the price at which you are going to eventually sell it will reflect what is happening in the principal market. Okay, so do you have an idea of what the principal market would be? What's the principal market? I can't hear you. You're not sure. So it's a market where there is high volume of activity on that asset. High volume of activity on the what? On the assets. Okay, so there are a lot of assets that has principal markets. And of course, there will be some assets that will not have principal markets. It's not all assets that can have principal markets where there will be high volume, because there are some assets that you can get it from different places. There is no one particular place that everybody would actually go to. Like if you are mentioning assets like shares, for example, now everybody knows where the principal market is. If you are mentioning assets like debt instruments, you can easily know where the principal market for that is. If you are mentioning assets like maybe computer or laptops or phones in Nigeria, you can easily identify where the principal market for that is. Okay, so when we say an orderly transaction, we expect these four to be present. Normal market condition, the buyers and sellers are knowledgeable, it must be marketed for a reasonable period, and the price must reflect conditions in the principal market. So, for example now, if you have, let's say you have an investment property, that you want to sell. And this investment property, you'd marketed it for, let's say, 6 months for people to be aware of that product or of that asset. You received multiple bids from buyers. People are selling their prices. Then eventually, you sold it at the market price. See, that scenario I've given you is what we call an orderly transaction, because you marketed it for a reasonable period of time. You received multiple bids. I mean, you gave people the opportunity to be familiar and understand the market, to have knowledge about the assets. You see, the price at which you will receive eventually is fair value. But if you had sold the asset for, let's say, within 2 days, and it was even a single person that bidded, that can never be fair value. You see, all these are important. When you want, before you can call something fair value, you must prove to us that that transaction took place orderly. Or you want to sell shares, for example now. You have shares, and you sold those shares on the market. You see, the price you receive is the fair value. If you had sold it off market, maybe you just transferred it to your friend, that just give me this price. You don't want to wait for bidding process and all of that. That is not fair value. Because if you have sold it on the market, you will see that that's a market that is active. People have knowledge about what the prices are. So the price you eventually receive is the fair value. Or probably you have an equipment that you want to sell, and because you are under liquidation, so you just put a price on it, and buyers now took advantage of that distress sale, so you now receive money. You, accountant, you cannot call that fair value, because that transaction is not orderly. It does not meet this condition. So don't take it literally. When we say fair value is the price that is received to sell, no, it depends. We have to be sure that it is in an orderly what? Orderly transaction. So even if you want to liquidate, and for us to determine fair value in that kind of scenario, we need to ensure that market participants or buyers and sellers were given time to understand the assets. The assets were marketed for a substantial period of time. Then the price you will eventually receive will represent the what? The fair value. That is an orderly transaction. Now, the next one here is market participants. Market participants. Market participants. Of course, when we say market participants, you see, the price that is received, or fair value generally, is determined from the perspective of market participants. Is determined from their perspective. And market participants, we are talking about buyers and what? And sellers. And these buyers and sellers, first of all, they must be buyers and sellers that are knowledgeable about the assets. Secondly, they have to be buyers and sellers that are independent parties. They are independent. They are acting in their own interest. They are not related to one another. They are independent parties. They have to be buyers and sellers that have the financial ability. Not somebody without funds. That person will just be calling it funny prices. You must be sure that he has the financial ability to participate. And finally, they have to be what? They have to be willing. So, for us to even consider fair value determination, we must be sure that these participants are people that are knowledgeable, independent, financial ability, and willing. So that means that, following from the examples I've been giving you, if you sold a commercial property, an investment property, at a certain amount, before you can assume or conclude that the amount you receive is fair value, you must look at the person or the participant involved. So for a commercial property now, the participants we should expect should be real estate investors, for example now. Okay? People that have knowledge about that commercial property. Or let's say a corporate buyer, a company that wants to rent a property. It was now the party. We expect companies should have hired professionals that will understand that market. Or probably a real estate fund. There are some funds that their core business is investing in real estate. Those ones must be the parties involved. Anything outside of that, probably you did the transaction with a family friend or with your colleague. That is not going to happen. Again, if you sell shares on the market, that you don't have to really speak so long on that. The market participants will be probably the retail investors there, or institutional investors, or an investment firm. Those will be the right market participants to actually operate in that kind of environment. Or probably you sold a startup. So which market participant are we going to looking at there? We could be looking at probably a venture capital firm, or probably we are looking at an angel investor. I mean, we have to be looking at those that are experts in buying all these kind of what? All these startups. So all these things, we really take them the way they are when we are determining fair value. These parties involved, they have to be market participants, knowledgeable, independent, financial ability, and what? Willing. Finally, is at the measurement dates. So when we are talking about fair value, when it has checked all of these other boxes, then because there might be plenty values, which value is then the fair value? You see, IFRS 13 says that is the value at the measurement date that will be the fair value, and it concluded that measurement date will usually be the reporting date, which is the date you want to account for that transaction. So you will get what is the value at this reporting date, then that will most likely be the what? Be the fair value. The reporting date, the date you are reporting for this transaction. So if you sell shares, is the share price, or you have shares, you might not necessarily sell, but you want to know what the fair value is. Okay? What is the price you will receive at when? At the reporting date. So when we say measurement date, we are talking about the year end. That can easily represent our measurement date, just the year end of the company. And that is the definition of fair value. And this definition, when you want to determine fair value, it has already covered a lot of issues that needs to be looked at. And if all these boxes are not properly checked, then your value is not what? Is not fair value.